I was very excited about being here with you guys and giving you a little update on the housing market. We know that it's gone through some changes over the last few months, and really the genesis of what we're doing tonight came because we had a lot of our clients and potential clients that were coming to us about the middle of June and had some concerns about the economy, about the housing market, about moving forward with their plans of building a new home or planning to build a new home in 2023 and beyond. And so, very legitimate concerns. And so, we wanted to address those because, quite frankly, there's a lot of information that is out there. Some of it is misinformation. So, we just wanted to make sure that we were presenting, since we were kind of answering the same questions over and over, that we were presenting you with the proper information for you to make the best decision for you and your family. So we want to make sure that we're looking at things from a historical perspective, really without a lot of hyperbole or agenda, so to speak, and just kind of look at what the data tells us, where we're at now, and what we can expect into the near future in the housing market. Again, there's been some shock for the last few weeks and couple of months now, and rightfully so. Those questions need to be addressed, and we need to talk about them. So we kind of want to go through that to give you the information to where you can decide if now's the time for you to move forward, or if there are legitimate reasons that you should pause your project now. So Greg is going to help me as we go through this tonight. We've got our slides here. Excuse me just one second while this is coming up. So we looked at reasons to pause. And the first one, obviously, our interest rates are going up. Again, we talked about middle of June. Well, and I'm going to give you a little bit of background a little bit. So I'm going to use a lot of U.S. figures and U.S. data. And that's why Greg is here to kind of help me with the Canadian side. There's a lot of similarities in both of our economies when it comes to how the housing market works and how the interest rates works and the economy at large. We're very dependent on each other as it relates to housing and the economy. But a lot of my information is going to be kind of U.S. centric. So forgive me for that. And Greg is going to help kind of fill in some of the details or some of the differences between what the U.S. is experiencing versus Canada. But when we talk about interest rates going up, the U.S. Federal Reserve in the middle of June raised interest rates by 0.75, or what we call 75 basis points. Which was a significant increase in June. And the reason why, we all know that the mandate of the Federal Reserve is to get runaway inflation under control. And the idea is that with the rise in interest rates, they can help kind of curtail inflation and get it to where if you listen to Chairman Powell, the ideal is around 2% inflation. We're well above that currently. So in June, they raised it 75 basis points. And then we turned around in July and did the same exact thing, another 75 basis points. And then the anticipation is that at the next Fed meeting in September, in about a week or so, no one knows exactly sure, but the idea is that, and the expectations are that there's going to be another rise in interest rates. So until inflation gets under control, according to what the Fed deems it under control, we can expect some rise in interest rates. So it's a legitimate concern. And I think, Greg, you've experienced some of the similar in Canada. Is that correct?
Yeah, thanks, Curtis. As he talks about this, Curtis is based in the U.S. and we'll talk to him. We are really one big boat with Canada and the U.S. here, and just back and forth slightly, but we are essentially experiencing all the same things. In Canada, you talk about your overnight rate there with the Fed. In Canada, we just had an increase from 2.5 basis points to 0.75. It just went up again last week. So we're at 3.25 right now in Canada. And the US, they have a range. They were 2.25 to 2.5. And like Curtis said, it's expected to go up 75 basis points. So they'll be at 3.25 too. So we're 2 weeks ahead of you guys for bumping it up, but it looks like it's going to be exactly the same after that.
Great. Yeah, and that's a big concern, right? I mean, because it really affects basically what your monthly payment is, right? When you start looking at interest rates. Now we're going to talk about some of the differences between the mortgage interest rate and what the Fed rate is, because there are some subtle differences. But the Fed rate really affects all interest rates across the board. Fed rate, for in simple terms, is what banks charge other banks to borrow money. But all rates, whether it's a car loan or student loans or mortgages, all kind of follow the trend of the Fed rate. So another concern is home prices are just too high, and we've experienced some rapid growth in home prices over the last 18 months, 2 years. In fact, at the end of the second quarter, there was a report that said that profit margins on a typical home sale hit another record, rising 56%. So investment returns in the second quarter rise at the fastest pace in more than a decade. The median sales price of new houses in July 2022 was $439,400. That's U.S. dollars, U.S. houses. The average sales price was $546,800 in the U.S. and $629,971 in Canada in Canadian dollars. So these prices, that's the average, are far more than what we could have ever imagined at this time, even 2 years ago. So you're right, that's a big concern. Home prices are continuing to rise. Another factor that people are looking to pause, and I think this affects the U.S. maybe more so than Canada, but it's still a concern. There's a lot of people that are waiting to see what happens with the midterm elections that we have coming up. Obviously, it depends on what side of the aisle you fall on as to what you want to see happen. But the idea is that we've become way more polarized in over the last decade or so, and it gets worse, it seems, as we move forward. So a lot of people really are basing a lot of buying decisions on what happens with the presidency or with Congress or a lot of different things that happen. And we're going to look at that and how policy affects what's going to happen in the future. And then finally, we've got some people that just come straight out and say the economy is going to crash. And they look at all of these different things that are happening with interest rates, with inflation, with the supply chain issues, with everything that's happening in the world. There's a lot of negativity that's out there, and we have people that legitimately have come to us and said they've been bombarded with all of the negativity that's out there, and they just truly believe that they do not want to make a big investment at this point because there's major concerns about the economy moving forward. So we want to take a look at each one of these and see how it kind of works. If you go all the way back to the interest rates, and that's really what's driving a lot of the reason to pause now. The idea is that, again, with an increase in interest rates, it's going to slow the economy, right? Because it becomes more expensive to borrow money, to buy houses, buy cars, to increase business expenditures, things like that. So the idea is that if we can slow the economy a little bit, it's going to, reduce the inflationary period that we're in right now. A lot of people believe that with the increase in interest rates, that's also going to cool the housing market to the point to where home prices are going to retreat. And it makes sense logically because, again, if the interest rates are going up every time that the interest rates go up, your mortgage interest rates go up, theoretically, you're taking people out of the market, right? Because people are deciding that they don't want to move forward. So that means that demand is going to fall. And obviously, if demand falls, then that means that the prices have to fall. Remember Econ 101, it's all supply and demand. So if demand falls, then there's a good chance that the prices are going to retreat, that homes are going to become more affordable as we move forward because there's going to be fewer people in the market. So we're going to look at that. And I want to look at it from a historical perspective. And really one of the things that I did, and all of this data is free of charge, and you could go to the what's called FRED, the Federal Reserve Economic Data, and it's all there for you to kind of look at and kind of this is not based on opinion; these are based on the actual numbers that are published. And this is again, these are U.S. numbers, but it's really very similar when we look at these trends moving forward. So one of the things that I did is I looked back over the last 50 years, and I studied these periods of time where we had rising mortgage interest rates to see what happened with home prices during that period of time. And if it's true that a lot of people were saying to me is that the interest rates are going to rise, then the home prices are going to fall back in line. So I went back to all the way to 1971. It's the year I was born, by the way. So this was just a few months before I was born. May 7th, 1971, the starting mortgage interest rate was 7.38%. And again, compared to today, obviously that's still much higher, but that was a starting interest rate in May 7th, 1971. As the period of rise ended on October the 4th, 1974, the ending mortgage interest rate was 10.02%. And this is on a 30-year fixed mortgage rate. So, but what happened to home prices during that time? Well, home prices went up by 44.2%. So the median sales price of homes when it began, the interest rates began to rise on May 7th, 71, and then it ended on October 4th. During that period of time, home values increased by 44.2%. So it got me thinking a little bit, what happens after this period of increase? If you want a gentleman reminded me that sometimes this is the medicine, right? So the medicine is rising interest rates to cure the problem, and then the problem on the backside after the rise is there should be a retreat, or there should be a recession of or not a recession but a retreat in home prices rising. So I looked at what happened between these periods of time, and from the second quarter of 1975 to the second quarter or the fourth quarter of 1976, home prices increased by 10.4%. So home prices continued to rise whether the interest rates rose or not. I said, okay, well, that's the first one. So let's look at some other data. Check these numbers out. These are the Carter years. You look at March 4th, 1977 through April 4th, 1980. Started at 8.65, ended up at 16.35%. Can you imagine 16.35% mortgage payment on your mortgage right now? It is hard to even fathom that happened in the early 80s. So, but even during that period, it was 31.2% home price change. And then right at the end of the Carter administration, beginning of the Reagan administration, if you guys remember during that time, those who are old enough to remember, there was a lot of things going on in the world. We had the Iranian hostage crisis, and Cold War was in full effect. We were having some issues with OPEC and oil and energy crisis, lots of negativity going on, but really it was the economy that was the reason why it was such a sweeping victory for Reagan when he came in the 80s, in 1980 election. And this is primarily what took place. So 12.18% starting mortgage interest rate ended at 18.63% interest rates on your mortgage. Unbelievable. But even during that hardship time, a lot of negativity, home prices continue to rise, 8.6%. And again, after this period of time, we still had a 12.5% increase in home prices before we get to this next rise. So I won't bore you. I know this is a lot of numbers and a lot of stuff to go on, but again, there's been 10 significant times, and all of them, it's the same story over and over. Rise in mortgage interest rates do not equate to a reduction in home price changes. So honestly, your home price change is pretty much insulated from what's happened with mortgage interest rate. That's what history tells us, that every time there's been these periods of rise, there's also been a period of home values rising, which brings us to where we are today. January 6th of this year, interest rates on the 30-year fixed was 3.22%. August 25th, my birthday, by the way, August 25th, mortgage interest rates 5.55%. So again, that's a significant rise in a short period of time in the first half of 2022. Again, the whole purpose is to try to get inflation under control. So what has that done with home prices the first half of this year? Well, your value has increased by 13.8% year to date. Now, again, not expected to hold at 13.8 through the rest of the year, but it's still going to be a significant increase from the beginning of the year in home price change. What does 13.8% kind of mean to you? Well, basically, if you paid $400,000 for a home on January the 6th, that home is now worth, you gained $55,200 in that period of time. Now, again, home values are not expected to maintain that throughout the rest of the year, but annualized, I mean, that's one way to look at it. Where at the same time period, that same $400,000 investment in the stock market or any other kind of vehicle this year is not done nearly as well. So just to kind of something to kind of think about, that even though interest rates are up, home values continue to rise. So what about policy, though, Curtis? I know it's very, very important. Very volatile times when it comes to politics, when it comes to decisions that Congress is making, that politicians are making. I hate to burst anybody's bubble, right? And I don't want to make it sound like that it's not important, because it's extremely important. Those of us in the industry and those of us in the economy at large, we want to see certain things happen, right? And we continue to fight and push for policies that's going to benefit the housing industry and the economy at large. But the truth of the matter is, if you look at all these dates of rise in interest rates, there was a lot of different parties and affiliations that took place. And I'm not saying that politics don't matter. I'm just saying that it is not. This is to the chagrin of people who want to think otherwise. But ultimately, whether or not you're a Democrat, Republican, liberal, conservative, or progressive conservatives, they are all subject to the same cycles in the economy, as far as interest rates and as far as home values. Now, the good thing is that regardless of your politics, values of homes are pretty much insulated from political partisanship. So which is a good thing, right? Now, policies contribute. It's just not the primary factor when we look at what the results are going to be as we move forward. History tells us that political power in Washington or Ottawa is really not a primary factor when it comes to long-term health of the housing market. So if political policy is not the primary factor, then what really is a primary factor when it comes to housing? And really, it kind of boils down to population, right? Remember, if you look back at Econ 101, we're talking about, the basics of supply and demand. Again, politics and policy contribute. There's a lot of contributing factors, but the driving factor And what happens in the housing market is primarily population. I've heard a gentleman say one time that demographics is destiny. And I want to look at some of that based on the chart that you see on your screen now. You know, we look at different generations, and these are births per year in the US. And if we go back to this silent generation, right before the baby boomers, those are people that were born in the years 1928 through 1945. So there were 47 million born during that time period. Those people are now between 77 and 94 years old, right? So what happened and why was there such a peak? The next generation is the baby boomers, and that's the largest generation by far, right? 76 million baby boomers. You know, and if you look at this very, very sharp increase in population from 1945 onward, we all know what caused that, right? It was the World War II ended on September the 2nd, 1945. And all throughout Europe and North America, those soldiers came home and were happy and celebrated and ended up having a lot of babies. So created this baby boom generation, and the folks that were born from 1946 through 1964, they're between 58 and 76 years old now. And then as you kind of move forward, this Generation X, it's my generation, there's a lot fewer compared to the baby boomers. So there's 55 million people that were born in the Generation X years, which is between 1965 and 1980. So people in this generation, my generation, they're between 42 and 57 years old today. And again, if you look at that generation, I should point out a couple of things that are really, really important. Big dip in population between 1971, 72, 73, 74, drastically reduced the number of births in Generation X. One of the things to keep in mind, and we're going to look at some of the causes of what's going on now and actually what happened in 2008, the way that economists look at population and as it relates to the housing industry is that household creation, it's generally when people get in between 30 and 35 years old. The sweet spot is 33, right? So now it's not to say that you can't create a household when you're in your early 20s. Obviously, that does happen and can happen. And also, people wait later in life. You know, it could be your 40s before you have your own household. But in general, most people in their 30s are starting families, they're buying homes, they're establishing households. So new household creation is based on births between or people ages between 30 and 35. Well, if you look at this chart, 1975, if we bump that 33 years, then that puts us right in the middle of 2008. And we all know what happened in 2008. We're going to look at some of the causes of it. But this huge population dip in the early 70s was a primary contributing factor to our housing bubble that we experienced in 2008. Now, the opposite is true also. There's more millennials than there are Generation X. So there's 66 million people that are in the millennial generation. And those are people that were born between 1981 and 1996. So these people today are between 26 and 41 years old. And these are the new households that are being created around the world. So if we look at what's happening that's affecting home prices and demand now, you see these big spikes as we start to increase in the number of births. Again, let's look back 30 to 35 years ago from today, and we notice that there's big spikes. So these people, this big birth increase in population is really affecting the market today. So again, 1990, we know that 2023 is going to be 33 years from now. So next year, there's going to be far more people that are creating households than there were last year, the year before, or the year before that. So the demand is continuing to rise. In fact, when we look at household growth versus annual completions, I want you to kind of notice this. The blue bars in each of the years listed below, the blue represents the number of new households. So again, those people that are 30 to 35 years old that are entering the marketplace as a new household creation. And then the orange bar are the annual completions. So new households being created are the blue, and the new homes being completed are the orange. Now, in a healthy economy, you want your orange bar to be slightly above your blue bar. Because in general, there's going to be about 100,000 homes a year that are destroyed for whatever reason. It could be, roads coming through, or it's just dilapidated, or it's torn down, or it's fire, whatever. There's 100,000 houses on average that are destroyed. So for a healthy economy, you want to have your annual completion slightly above your household growth. If you notice, and then again, this is again population or demographics is destiny. We look back at 2000, beginning in 2005, this, your orange bar starts to get a little bit higher, a little bit higher. 2006, the number of births significantly dropped off. Again, it goes back to those years in the early 70s when new births were lower. That translates 30, 33 years later to less people getting into the marketplace. And we see that in 2006. Now, again, if you're a builder, as I was in the early 2000s, you're not necessarily looking back 33 years at population growth. Which is a mistake, because as a builder in 2004, you had a pretty good year. So what do you do in 2005? You build more houses, right? You build more spec houses to capture more of a marketplace, because we're all competing with each other. And what do you do in 2006? You build even more. But what we didn't realize is that, looking back on time, that the number of people that were going to be available to buy homes greatly reduced. In fact, if we look at 2007 and 2008, this right here is your housing bubble. And this is what created all the issues that we had in 2008. Now, again, lots of other contributing factors. Policy was one. It was a mortgage issue. There was a lot of different things that were going on. But the truth of the matter is that we don't need to overcomplicate this. It was a supply and demand issue. We had way more supply than we did demand, and this is where the bubble burst. So 2009, 2010, we're in the mixed of recovery at this point. Now, something happens in the early teens that we completely flip that script, because again, we forgot about demographics being destiny. So as we continue to recover as an industry, the housing industry, we're slightly increasing, but we're not taking chances on building specs. We're building, just enough to make sure that we're not going to experience any of this negativity that we did back in 2008. The problem is that the household growth, new households, are far outpacing what the annual completions are. So by the time you get to 2017, 2018, 2019, this blue line is more than double what the orange line is. Again, and it gets worse as you move forward. So remember, 2023 was that great big peak. Here's where we are, what our demand is. Now, the white is 2022. We know that that's the number of new households. We already know what that's going to be. So far in 2022, through July, there were 572,000 new homes completed in 2022. Now, if we double that, let's say we continue on that pace and we double that through the rest of this year, and we do the same number, we complete the same number of homes in the second half of 2022 that we did in the first half of 2022. By the end of this year, we're going to be 1.3 million homes short of what's needed for household growth in this year alone. And that doesn't account for what we were already in a deficit for in 2021, 2020, 2019, all the way back. So again, at the current pace, we're still going to be 1.3 million homes short of what's needed for household growth. In fact, we've only started 564,000 new homes in the first half of 2022, and that's actually an increase. So we've increased the number of new homes that we've started in the first half of 2022 versus a year ago by 1.2%. Sounds great. We're building more houses. The problem is that the number of new households created during that same time period increased by 9%. So we're not even keeping pace with what is happening on a yearly or quarterly basis. So the further we get behind on annual completions, the higher that the demand is going to be moving forward. So now let's look at supply of existing homes. In a healthy economy, you want about a 6-month supply of existing homes. Again, this blue line shows that the homes for sale per million. And this is a U.S. chart, and it shows the months of supply. Again, when we look back on the bad years of the mid 2000s, we see how the months of supply is crazy high versus the number of homes per sale. But again, as we move through this increase in population, we see that in 2022, we've got 2 months of supply, and it's actually a little bit less than that right now. Less than 1 million homes for sale. When I did this chart, the total number of houses for sale at the end of August 2022 in the U.S. was 779,000 homes for sale. So 779,000 across the entire country. And I think Greg has got some, he's going to talk to you a little bit about the household. Greg, I'm missing your slide, but it's
great. No problem, Curtis. The big thing for me is you're showing in the previous slide there too. It mimics that in Canada. There's no question about that. The previous slide where you had the big shortage in houses there. The other thing for everybody to consider, none of those blew the household growth. Think about your neighbors, your family. How many of those households are in the construction industry? We are not catching up anytime soon. There's been nobody entering the trades. This deficit is going to go on for a long time. It takes a long time between training people. I know there's government focus on that and affordable housing and such, but that gap between those is massive. It is not, I don't see us catching up for decades, honestly. There's nobody, it's not only the population and the needs, it's the labor availability to do it, which is just crazy. We looked at some Ontario, in Ontario and Canada, the graphs there in the census metropolitan area. Like, do you think that these builders don't want to be building more houses now and, capture those sales, like to get that orange up to the blue? They can't. There is not the availability of the people to do it. So when you're looking at total construction costs and the labor side, materials have gone up, commodity lumber's come down, every other material's continued to go up. It is not going to get cheaper to build a house. I can confidently say that. Maybe short term a blip, but there's nobody to build them. And the demand is just continuing to increase. Population for Canada is kind of the only thing that differs from the States. We're all in that kind of big boat where we mimic everything. A little bit to do with politics, but even our conservative, is a newly elected conservative leader. Canada has like immigration first policy, essentially. So over the next 22 years, I think the U.S. population is expected to grow 11%, and primarily from the birth rate. In Canada, a good chunk of that is immigration. So the government set a target to have 4,000 immigrants a year immigrate to our country. So Canada's population is expected to grow 25% over the next 22 years, so 11 to 25, big difference there. It's easier to make some bigger numbers because we're starting with a smaller population, but big difference there. So in Canada, I can see it even getting worse, unless those people that are immigrating are carrying hammers and are plumbers and electricians. I don't know that, but that's all we can hope for. But everybody that's immigrating is going to need a house too. Like you've got the data there, Curtis. Like this was so interesting for me to see. It's houses, the demand is going to be based on population, and the price is going to continue to increase. There might be short blips where you have small drops. Anybody hanging on to anything for a few years, the data's there. It's just, and we know what's coming, and it is just going to get worse.
Yeah, and so again, when we talk about supply of existing homes, like Greg had said, it really kind of mirrors what's happening between the countries. We just don't have enough. I mean, bottom line is there's just not enough new homes being built to meet the demands, and the deficit is so huge right now that it's almost impossible to catch up. So what does that mean? Right? We talk about there's been some stories about housing is definitely in a recession, that we've missed the market. I hear that all the time, that we've missed the market, to sell our home or to move forward. It's still at 42 days, which is, pretty much average. If you look at this, you go back in time, the number of days on the market, average days on the market, and this is throughout the U.S. This is the median. These seasonal dips are pretty standard from year to year. But if you look at, in May it was 31 days, but now it's 42. So I mean, it's an increase of 11 days on the market. It does not represent a slowing down in what's happening. Now, one of the things that has happened is that there are fewer homes going on the market today, which again, almost inevitably is going to contribute to this lack of demand or this lack of supply that we're experiencing. So again, we're averaging 42 days on the market. That's the same average for the last 18 months, and the same average for the last 12 months is exactly where we're at right now. So what does that mean then? How does that translate to other areas of the economy, especially when we talk about rental market and rental market pressure? Because again, with interest rates going up, affordability becomes a crisis. So we want to look at what's happening in rental markets. And these are just some headlines over the last few weeks. Rents in the U.S. rise at fastest pace since 1986. Just absurd. Apartment rent prices skyrocketing in Charlotte. That's my hometown. Again, this poor guy here sitting with his boxes on his pillow, probably leaving, I guess, wherever he's at now. So rent prices continue to rise per consumer price index, not likely to slow soon, experts say. I looked recently, there's a rent report. You guys can find this online, August 2022. It basically says that in the U.S., the average one-bedroom average rent, $1,770. Again, month over month, percent change up 4.1%, year over year, 39% higher. On average, 39% higher for a one-bedroom to rent. This is across the United States. Same thing for a two-bedroom, obviously 38.3%. So nationwide rent prices in July were up month over month. Again, year over year increases continue at a steady pace, blowing past this 30% barrier. Experts had expected the end of summer to usher in a period of moderate price increases. So far, that has not been the case, as prices and inventory in the housing market remain strong and mortgage rates volatile. Just to give you a little example, this is from personal experience. I'm I can call myself a newlywed for one more month. I actually was married in October, but for 2 years previous to that, I'd moved to the Hickory, North Carolina area, and beautiful apartment complex that I was living in. So less than a year ago, when I moved out of my awesome one bedroom, one bath, 715 square feet apartment, I was paying $925 a month, right? A year, less than a year ago at this point. I checked when I first did this, and this is my little apartment. You see my little kitchen and little patio. Very happy there. Listen, I was not complaining. I always recommend this place. Great place. But again, one bedroom, one bath, 715 square feet. And when I did this, it was $1,499. $1,499 from 925 less than a year ago. To show the volatility, I updated my slides before this presentation because we've done this presentation a couple of times, and this is actually my unit, $1,557. This was yesterday. So that unit is available now at $1,557. But less than a year ago, I was paying $925. So 70% increase just from that in rent. So again, rental rates are out of this world. And you guys in Canada, I don't need to tell you that. I mean, you guys can look through your average rents in Toronto and Montreal, Mississauga, really all throughout Canada. It's something that you guys have been experiencing for a long, long time. Again, there's pressure. Does it get worse or better with interest rates rising? Obviously, this is going to be it's going to get worse because again, it's related to demand. On that image that I showed you about that one bedroom that's available now, that's the only apartment in the whole complex that is available. So just finding a place to rent is a challenge for most people. So we've talked a lot, given you a lot of statistics about the economy, about what's happening with the market. Wanted to dispel some myths, but real question is now the best time for you to build a new home or to get started? I mean, if you have it in your mind that that this is what's good for you, should you wait or should you move forward? And I can answer that by really saying that real estate is historically the most profitable investment vehicle available. And if anybody ever tells you anything differently, they are not telling you the truth. When you look back through the numbers, there is no investment vehicle that's going to give you a consistent return on your money than investing in real estate will. Now, again, the real estate market is a little bit different because you make a choice to invest in whatever you want to invest in, the stock market, Bitcoin, gold, savings account, whatever you want to put your money for your investment, 401k. All of those are choices that you make. The home is something that you have to have, right? It's a shelter. It's part of our something that we have to have in order to be successful in life, right? We got to have a place to live. We got to have a safety to raise our family. So it's a little bit different, but if you're looking at it from a purely investment standpoint, there's still nothing that gives you the consistent returns that real estate does. And that's happened over and over. As we look back through those periods of time in the beginning where we talked about prices increased, home values increased, or when mortgage rates increased, home values increased. When mortgage rates came down, home values increased. There's one thing that we're not economists. We're just telling you what the historical data tells us and what the trends are moving forward. But we're not economists. So we're not guaranteeing anything that's going to happen. But from a personal standpoint, I can tell you that I don't know if interest rates are going to rise. I expect them to rise again in a couple of weeks when the Fed meets. I expect them to rise again. And I expect them to continue to rise through until inflation gets under control. But I can't guarantee that. I don't know what interest rates are going to do. But one thing that I do know that I can guarantee very, very strongly is that home prices are going to continue to rise. They're going to go up because history tells us that that happens on a regular, consistent basis. In fact, it's the same in the U.S. as it is in Canada. I got some numbers here that the average Canadian has over 60% of their net worth is in real estate. And in fact, the real estate makes up over 50% of the Canadian GDP. It's about 25% in the US, but really real estate is about 50% of Canadian GDP. Um, we as we look through, if you're waiting for interest rates to go down, you're missing out on home values and equity gains because, as we already talked about, you can't stop that train. Home values are going to continue to increase. And when they increase, your equity also continues to increase. In fact, the reason why there's so many people in the market and with the high prices is because a lot of people are they have positive equity in their homes, meaning that they're over 50% value versus what's owed. And that's the majority of homes across the United States right now, is that what is owed on that home is less than 50% of what the home's value is. So if you look at that, and also Canadian housing market is the same. It says, Canadian housing market has averaged a 6.11 yearly appreciation over the last 15 years for a total appreciation of 143.5%. Think about that for a second. So if you bought a $260,000 property in Canada in 2005, that property would now be worth $634,000 on average. Now, keep in mind, if you finance that purchase, that would translate to a $374,000 capital gain on a $52,000 investment, because you didn't pay cash for it, right? You financed it. So you've invested $52,000 into this home in 2005, this $260,000 home in 2005, and now it's worth $634,000. So again, that translates to $374,000 capital gain on $52,000 investment over a 15-year hold, plus any mortgage principal that you've paid down, and if you happen to rent it, that's positive cash flow, right? So again, there's no better investment vehicle for you than real estate. And again, if you're waiting for those interest rates to go down before you move forward, you can't go back in time to gain the equity that you're missing out on. Again, we talk about people saying that they've missed the market. Heard that a lot in 2008, 2009, or we hear people say, when the housing market was in crisis during that time, man, I bought at the peak in 2007. I bought at the peak. I'm upside down right now. How many of you out there would love to go back right now and buy at the peak of 2007 prices, right? Because we've seen that within a 2-year period of time, all of those gains were back and we're raging forward when it comes to home prices. So nobody lost any money when the housing market crashed unless you had to sell. Again, those homes that were underwater for that brief period of time, that 8-month period of time in 2008 and 2009, are now worth, X number of times more than what was invested back then. Again, you can always refinance when interest rates decrease. Millions of people refinance every single year for various reasons, but most people refinance when the interest rates come down. So, the chances of you holding on to the same interest rate throughout the life of a loan is very, very low, because even at low interest rates, back earlier in the year, we were getting down to close to nothing as far as the mortgage interest rate. So, there was a lot of people that did very, very well refinancing a few months ago. But if you'd asked those people, same people, 2 years ago, was that a good rate? It was like, absolutely, that's a great rate. And many people had refinanced to that rate before they refinanced again. So throughout the life of a loan, you're going to refinance at different times, or you should at least consider that. And again, building wealth really requires a long-term strategy. So the question is now the best time for you to build a new home? And honestly, we can't make that decision for you because everybody's situation is different, right? Everyone's situation is going to change based on their particular needs and their particular financial, health at any given point in time. But what we wanted to do is just present some facts to you so that you are not delaying making a decision based on fear or based on what possibly could come in the future, or with the hopes that things were going to that home prices were going to decrease moving forward. We wanted to present some facts to you that is not likely to happen. In fact, we don't see any way that it can happen based on the demand that is out there. I talk about this example, when people say that they missed the market, it goes back to Microsoft. We're talking about stock markets for a second, and Microsoft stock. You hear people all the time. I've heard this throughout my life. Boy, I really missed out. I could have bought Microsoft stock and been a millionaire at this point. That's true. So in 1992, based on the number of shares, and there have been some splits through the years, but in 1992, based on the current number of shares, the one share of Microsoft stock was $2.18 in 92. So in 2002, it was 26.11, increased by 1,000% in that period of time. So in 2002, a lot of people look back and said, "Man, I missed it. I missed the market." Right? I could have got Microsoft at $2.18. Feel like it's at a peak that's not going to go up anymore. I missed out on it. By 2017, it was $72.49. Same thing. Same conversations were happening throughout. Man, I really missed out. I could have got it for $26 back in 2002. Now it's at $72. Well, 2 years later, in 2019, it's $133. And then today it's trading at $266.65. So again, don't miss out on your equity gains when it comes to long term based on fear. That's really the whole purpose of what we're trying to talk to you about. So you got some good information to help you make the right choices for you and your family. All right, so again, I'm Curtis McCurry, and Greg helped us out. I got some contact information here. I think Penny may have some questions for us.
Yeah, well, first of all, Curtis, thank you so much for all these important questions. We're hearing them every day, and people need to know what's going on, and I really appreciate that, and I know a lot of people do too. And I do want to say, for those that do have questions, if you missed it at the beginning, because I think it's a little dicey there for a bit. So if you missed it at the beginning, due to the nature of this webinar, we are simply just couldn't open up the chat or the question and answer. It just wouldn't let. So if you want and have questions and jotted them down, we would love to hear from you. The email addresses are up there. And we're also going to send you an email right after as well. So watch your inbox in the next couple of days, and it'll have a recording of this and so on. So definitely keep those questions that you have on hand. Now, we have done this, like you mentioned earlier, done this a couple times before because it is really such an important topic. So what I can do is ask you some of these FAQs, and definitely, like, you talk a lot about national averages overall, but is it possible things could be worse in certain markets, like my local market?
Yeah, absolutely, absolutely. Because if you think about it, real estate is always a local issue, right? It's always local. There's an old saying that when it talks about different real estate or purchasing real estate, location. It's true that there are certain areas they're always going to outperform, and there are certain areas always going to underperform. what we see is that there's not an overabundance of areas that go extremely high or extremely low. So when we look at national averages, it's a good indicator, right, based on where you're at. But yes, there's always going to be variations based on your local market, and that could be from city to city, not just state to state, or it could be from neighborhood to neighborhood. So there's always going to be some local specificity.
Sure. Yeah. Okay. And another question too that you just hear, even just people on the street, if you start talking about housing and they're like, oh, well, there are going to be a lot of foreclosures that are going to hit the market. Will that bring the home prices down?
So typically, yes, that would. Now, will there be a lot of foreclosures? Well, I can tell you that right now, there's the fewest number of underwater loans in the U.S. than there's ever been in the history of record keeping. So people that have loans in the U.S. are, and I would assume, Greg, you can probably correct me if I'm wrong, in Canada it's probably similar, but there's fewer loans that are troubled right now than there's ever been in the history of the United States. And part of that is due, in fact, to some of the things that we put in place after 2008, 2009. People that have loans now are actually qualified to have those loans. They actually have employment. They actually have credit. Your credit score is a big deal now, right? In order to get approved, where it wasn't so much in the early 2000s. So again, with the equity gains that we have right now in the marketplace, and the so small amount of underwater loans, the chances of there being a large number of foreclosures is relatively tiny.
Yeah, there was essentially a bunch of crooked stuff going on at that time, right? Like they were giving loans to people that really could not afford it. That's gone. In Canada, we have the stress test. You have to qualify for a mortgage rate higher than is currently in the market, actually, to be able to do it. I think unless you have 20% down or something. So in Canada, we never experienced the same big drop like you guys had there, but yeah, it's even tougher to get a mortgage now. I don't see that. Can I just comment back to your last slide though,
Sure.
Curtis? Like you said, like it's like we don't know what's going to happen, but sort of like there's never a wrong time to buy or build a house. Like there never is. Like there's slightly better times if you hit a little dip, but there's never a wrong time to do it. And Curtis, your slide said, is this the right time to build? Well, what I'll say to you is this the right time to plan to build a house? Because if you're going to build a custom house, you are not talking about something you go in and you're going to write a check and get this process started and you're taking your house in a couple of days. This is best case scenario. You're going to take delivery of the house a year from the time you start. That's everything aligning. That's best case scenario. More typically for us is about a year and a half. Industry, you're probably talking a couple of years. And it could go even longer if you're running into any regulatory things. So is now the time? Like if you're waiting for the bottom, it's too late. Nobody ever knows whether it's the market, whether it's the housing, if you're waiting for commodities to drop as much as they can, which some people are doing. It's not just an interest thing. Some people say, oh, lumber's dropping, I'm going to wait for that to get better. Everything else is going up, labor's going up. But if you're trying to time it, by the time that that's the bottom, it's too late, because you don't know it's the bottom until you've got another 3 to 6 months of historical data to prove to you that was the bottom.
Right.
So what you need to do is, if you're going to build a custom home, you got to start now. You got to go through the planning stages. You got to go through the design stages. You got to get your approvals in place. You got to get your engineering done. You got to get your permits in place. Then if you want to pause, then you're ready to go. If you want to pause at that time, hey, no big deal. Put your foot on the brakes, pump the brakes, and you pause it. With our product, that's one of the ways that we sell. You can pause at any time that you want, but you can pump the brakes, but you can be ready to go. When you decide that you're ready to go, guess what? You're another 10 meters in front of everybody in that 100-yard dash. If you're going to wait till you hit the bottom when everybody else jumps in the market because it starts going up, well, guess what? You're 20 meters behind everybody else that's starting. So you got to get that planning portion. If you're going to build a custom home in the next couple of years, you got to get that done now. And then if you decide you want to see what's going on with everything, you want to pause and you want to wait before you make your next level commitment, and you want to put down a production deposit, or you want to engage a contractor to build it, you can pause it. But you can, when things do turn around, you're going to miss it, and you know they're turning around. You're only going to miss it by a month or two, and you're not going to start way behind everybody else. That, for me, that's the reality, and it might be hit home more in Ontario because we see what's going to be happening with the population. We know what's happening with the labor market. If you wait, it's too late. If you're trying to time it, I can tell you that with absolute certainty.
For sure.
Yeah, that's definitely, and we talk about that a lot. It's never too early to start that process. And by the way, that's a fun process. The planning and design is such a fun thing. Now you're talking about, and again, I'm not sure if we missed this at the beginning, but Curtis, you're in the USA, and Greg, you're in Ontario, and just so we know, and everybody knows, we are all over North America, or most of North America. So do you want to talk a little bit about that, Curtis?
Sure. Yeah. So again, we want to just present you the sort of the facts on the market so you make those informed choices as far as moving forward. If you are, after looking at this, and you feel comfortable about moving forward, or if you have more questions, and we're here to answer those questions for you, to see if it's right for you to move forward. But if you've made that decision, and you're just looking for a builder, then we would like to speak with you. We deliver all over North America. Timber Block is, we have model homes in North Carolina, Ontario, and in Quebec. We have dealerships in different areas of the country in the US as well. But really, we deliver, we design, engineer, and deliver packages all over North America. And we would love to talk to you about your project and see if we're a right fit for each other.
Yes, that's great. So again, if anyone has any questions, please use the information that you see on your screen. We want to hear from you if we didn't answer. Or Curtis, I mean, you guys both are just so great, and I think you answered so many questions that everybody, and I'm hearing daily. So I appreciate that, and I'm sure a lot of people appreciate that. So thank you for your awesomeness and explaining it in the way
Good job, Curtis.
And so, and I unless there's something else you guys want to add, I think we're about ready to.
I'll just throw in, if anybody's on the call that's from anywhere in Canada, it's English speaking, I can help them. I look after projects in BC, Prince Edward Island, anywhere. So not just Ontario. That's where I'm stationed.
Right.
Yeah, and then it's not on the call tonight, but our colleague in Quebec, Michelle Boucher. If you're in Quebec or French speaking, wherever, then Michelle is happy to assist you. And then yeah,
He speaks good English too.
Speaks excellent English, handsome man. So
charming. Yeah.
We will, and again, find out more information. Some of you have gotten the invites from Facebook posts, but I would encourage everyone to go to our website if you haven't done so yet, timberblock.com. Tremendous amount of information there as well, and we look forward to hearing from you.
And you can expect those emails in your inbox. So everybody have a great evening, and thank you so much for attending our presentation. Good night.
Thanks, Penny. Good night.